Hey guys, the 2026 tax brackets just adjusted for inflation. And if you're pulling income from your retirement accounts, this could change how much you should be withdrawing, or whether now is the right time to consider a Roth conversion. But here's what most people miss. While the brackets got lighter, the rules around Social Security taxation stayed frozen in place. That creates both opportunities and traps. And I want to walk you through what you need to know. Hi, I'm Jason Richard, a financial advisor at McKay Retirement Consultants. Every year, the IRS adjusts tax brackets to account for inflation. And in 2026, those adjustments are meaningful enough that they could shift how you think about your retirement income strategy. But the real story isn't just about the brackets themselves. It's about how these changes interact with everything else in your financial life. Your withdrawals, your Social Security, your required minimum distributions, and your long-term tax exposure. So in this video, I'm going to break down what's changed, why it matters, and what you might want to consider as you plan your income for this year and beyond. Hey, if this is helpful, feel free to subscribe for some more content. All right, let's start with the basics. The IRS adjusts tax brackets every year to keep pace with inflation. What that means in practice is that the income thresholds for each bracket go up slightly, so you can earn more money before you move into the next tax bracket. In 2026, those adjustments are in effect, and depending on your filing status, you might have a bit more room to work with. Now, if you're working and getting a paycheck, this is a nice little benefit. You might keep a little more of your raise. But if you're retired and managing income from multiple sources, now this opens up a more interesting planning conversation. Let me walk you through 5 reasons why this matters for retirees. First, your withdrawal strategy may have more breathing room. If you've been taking distributions from a traditional IRA or 401k, you've probably been thinking about how much you can pull out before being bumped into a higher tax bracket. For example, let's just say you're married filing jointly and you've been pulling in around, let's say, $94,000 a year in taxable income. In prior years, you may have just been at the near top of that 12% tax bracket, trying not to spill over into the 22% tax bracket. With the 2026 adjustments, that 12% bracket now extends a bit further, and that means you may be able to pull a few $1,000s more from your IRA without triggering that next higher tax rate. Now, does that mean you should automatically take more? Well, not necessarily, but it does mean that the math has shifted, and it's worth revisiting your withdrawal plan to see if you have room to cover an expense you've been putting off or to smooth out income in a way that makes sense for your situation. Look, the key here is that small changes in the brackets can create real opportunities when you're managing taxable income year by year. Second, Roth conversions might be more attractive right now. This is where things get interesting for a lot of people. If you've been thinking about converting some of your traditional IRA money to a Roth IRA, wider tax brackets mean you can convert more dollars before hitting the next tax tier. Let me give you an example. Let's say you're retired, you're in the 12% federal tax bracket, and you have some flexibility in your income. You might decide to convert, say, $30,000 from your traditional IRA to a Roth. Now, you'll pay tax on that conversion at your current rate, and in this case, 12%. That money can then build tax-free in the Roth, and you never have to take a required minimum distribution from it. That can be a powerful move, especially if you believe tax rates are going to be higher in the future, or if you want to reduce the size of your future RMDs. Now, with the 2026 tax brackets extended further, you may be able to convert a little bit more than you could have last year before crossing into the 22% bracket. That incremental room can add up over time, especially if you're doing partial conversions year after year. But, and this is important, you have to look at the whole picture, because conversions increase your taxable income for the year, and that can have side effects, which brings me to my third point. Third, Social Security taxation thresholds didn't move. Now here's the part that catches people off guard. While the tax brackets adjust for inflation every year, the income thresholds that determine how much of your Social Security gets taxed are frozen. They've been stuck at the same level since 1984. So what does that mean? mean? Well, it means that as your other income goes up, whether from IRA withdrawals, pension income, or Roth conversions, you can cause more of your Social Security benefit to become taxable, even though you're not technically in a higher tax bracket. Let me explain how this works, okay? The IRS uses something called the combined income to figure out how much of your Social Security is taxable. That's your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit. If those three things combined exceed certain thresholds, which is $32,000 for married couple filing jointly or $25,000 for singles, then up to 85% of your Social Security benefit can become taxable. So let's say you decide to take advantage of those wider brackets and pull an extra $10,000 from your IRA or do a larger Roth conversion. That extra income could push you over the threshold and cause a portion of your Social Security to be taxed that wasn't taxed before. And it's not a one-to-one increase, but it is real. And it's something you need to account for when you're planning your withdrawals. This is one of the reasons why I tell people that retirement tax planning isn't just about looking at the brackets. It's about understanding how all of these pieces fit together. Fourth, this affects your long-term required minimum distribution strategy. If you're 73 or older, you're already dealing with required minimum distributions, or RMDs. And if you're younger than that, RMDs are coming. The amount that you're required to pull from your traditional retirement accounts is based on your account balance and your age. And now here's the thing. If your account keeps growing, these RMDs keep growing too. So if you're in your 60s or early 70s and you have a large IRA balance, one strategy worth considering is using these wider tax brackets to your advantage now by doing partial Roth conversions or by pulling a bit more income from your IRA in years when you're still in a lower tax bracket. That can reduce the size of your traditional IRA, which in turn can reduce your future RMDs. And smaller RMDs mean less taxable income later, which can help you stay in a lower tax bracket when you're older and potentially managing higher healthcare costs or other fixed expenses. Again, this isn't a one-size-fits-all move. It depends on your timeline, your income needs, your other assets, and what you're trying to accomplish. But the 2026 bracket adjustments give you a bit more room to execute on this kind of strategy if it makes sense for you. Fifth, don't forget about Medicare premiums. One more thing I want to mention. Your income also affects what you pay for Medicare. If you're on Medicare, your Part B and Part D premiums are based on your modified adjusted gross income for the 2 prior years. So what you do in 2026 could affect your Medicare premiums all the way into 2028. There are income thresholds called IRMA brackets, income-related monthly adjustment amounts. And if you cross one of those income thresholds, your Medicare premiums can jump significantly. For some people, a Roth conversion or a large IRA withdrawal could push them into a higher IRMA bracket, which means they'll pay more for Medicare down the road. Now, that doesn't mean you shouldn't do the conversion. It just means that you need to factor in the cost. Sometimes paying a bit more in Medicare premiums can be worth it if the long-term tax savings are significant, but you have to run the numbers and think a few years ahead. So guys, here's the bottom line. The 2026 tax bracket adjustments create real planning opportunities, especially if you're managing retirement income from multiple sources. You may have more room to pull from your IRA without hitting a higher rate. You may be able to do a bit more aggressive Roth conversion, or you may decide to stay the course because pushing your income higher would trigger Social Security taxation or affect your Medicare premiums. Look, the point is this. This isn't something you can just figure out by looking at a tax table. It requires you to think about your whole financial picture, your current income, your future RMDs, your Social Security timing, your healthcare costs, and what you're ultimately trying to accomplish in retirement. Look, if you'd like help building a retirement income plan that takes all of this into account and adapts to changes like this, you can book a conversation with me using the link in the description. I work with pre-retirees and retirees who want to make sure that they're not leaving any money on the table or paying more in taxes than they need to. Folks, thanks for watching. I'll see you next time.